Target and Walmart recently reported quarterly financial results on the opposite sides of the spectrum. Walmart surprised on the positive side with excellent quarterly financial results that sent the stock price higher, and the stock price is performing really well in 2024. Target, on the other hand, reported disappointing quarterly financial results, and the stock price fell over 20% after those results. So this was a great time to do this comparison video to answer which one is the better dividend stock to buy, Target or Walmart. I'll look at several critical factors to compare these two and answer which one I think is the better dividend stock to buy. So let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right, the first thing I'm going to compare these two companies on is revenue. You can see over the last decade, Walmart has demonstrated better revenue growth and has overall much larger revenue than Target. Over the trailing 12 months, Walmart generated $673 billion in revenue. The largest company in the world in terms of revenue is Walmart. Target at $107 billion is only a fraction of the size of Walmart. In fact, Target only operates in the United States with 2,000 locations, whereas Walmart has over 10,000 locations and it operates in several parts of the world. The next thing, of course, dividend stock investors want to know is the dividend yield. Which one offers investors a higher dividend yield? And for this one, Target beats Walmart here. It offers investors a dividend yield of 3.5%. Whereas Walmart offers dividend yield of less than 1% at 0.9. But more important than the dividend yield, perhaps, is the dividend payout ratio. I want you to understand why that's the case here. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable, because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example, where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. Okay, so now that you've got an idea of why the dividend payout ratio is so important, you can see here Target has a higher dividend payout ratio at 47% compared to Walmart at just 33%. So longer term, It could be that Walmart increases its dividend payout, increases the dividend per share, and over time offers dividend stock investors a similar dividend payout compared to Target, even though Target right now has the higher dividend yield. The next thing I wanted to compare these two on is the operating profit margin. And Target has had the advantage here against Walmart over the last decade and will likely continue to do so. This is because of the differences in business model, right? Target sells a more premium experience to customers, and Walmart is a more focused on low cost. In fact, it's when you're studying a low cost position in business, Walmart is the case study. They are the quintessential low cost provider. They try to get you the products at the lowest price possible with zero premium experiences, with no fluff on top. They just try to get customers the lowest price. And they've done a lot of work to maintain that competitive advantage with their partnerships with the supply chain, logistics, store locations, etc. They've done a great job at that. Target, meanwhile, is a slightly more premium experience, a better shopping experience, more focus on marketing, more focus on things that look nicer, a better better store experience. They upgrade their stores more often, and so it targets a more higher income customer than Walmart does. Although recently, in the most recent Target and Walmart earnings release, Walmart said that it's actually gaining a lot of market share with higher income households, which was surprising to me. But it seems like higher income households are getting fed up with higher prices because inflation has gotten out of control in the US, but also around the world. And so consumers are looking to get more value for their dollar. And so they could be looking to Walmart more often than usual. And this will likely persist for several quarters more, as inflation is not going to reverse. It's slowing down, but it's not going to reverse. And so that could give Walmart an edge here as consumers are hyper focused on getting more bang for their buck. All right. And lastly, I wanted to compare these two on valuation. And you can see they traded at a similar valuation in 2023 to start 2023. And then Walmart really separated itself from Target here as the macroeconomic conditions favored Walmart's business model over Target's business model. Inflation was bringing consumers into the focus of more buyer value, and that favors Walmart. And so the valuation has soared and the stock price has increased too. Walmart's trading at a forward price to earnings of 13 compared to Target at a forward price to earnings of 14. I agree Walmart is the better business right now. However, I don't think it should be trading at almost 3 times the valuation of Target. So if I was a dividend stock investor looking at these two, I would say Target is the better dividend stock to buy today. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.